Gold is in a crisis, yet this should have been the time it's supposed to shine. The Middle East is still dicey, inflation just hit 4.2%, and the dollar continues being debased before our very eyes. This is the precise moment gold is supposed to fly. Instead, it's collapsed more than 25% from its all-time high, broken clean through its 200-day moving average, and the biggest banks on Wall Street are now slashing their forecasts. So, what on earth is going on? If you hold gold and are wondering whether to double down or cut your losses, this is a vid you cannot miss. My name is Nick, and this is the Finance Bureau. Now, for decades, gold's pitch was very simple. When the world catches fire, it goes up. War, inflation, a sink in currency, panic in the markets, gold was the one asset that thrived in chaos. And yet, here we are in the middle of all of that, with gold doing the exact opposite of what it's supposed to do. Back in late January, gold ripped to an all-time high of around $5,595 an ounce. It was the asset everyone wanted, riding a war premium and a fear trade all the way to the moon. And then, it just fell apart. By late June, gold had dropped below $4,000 for the first time since November, touching a high of $3,900 before bouncing back to around $4,096 where it sits today, at least at the time of making this video. Peak to trough, that's a decline of roughly 30%. Now, to put that into perspective, the last time gold suffered a drawdown this savage was the Great Gold Massacre of 2013, when the Federal Reserve was tapering its bond buying program and, like today, the dollar was strong and rates were rising. Except that one took a full year to play out, while the latest one happened in under 5 months. And the charts confirm the damage. In June, gold formed what traders call a death cross, which is just the moment that the 50-day moving average drops below the 200-day moving average. It is one of the most watched bearish signals there is, and it's gold's first real technical breakdown in nearly 3 years. The $4,000 level that was supposed to act as a bit of a floor has now flipped into a ceiling, and Wall Street has taken notice. Goldman Sachs cut its year-end target of $5,400 all the way down to $4,900, warning it could fall to $4,400 if things get worse. Put simply, the smart money is heading for the exits. So, the obvious question is, why is gold falling when every headline says it should be soaring? And the answer comes down to 2 words that govern the entire market: opportunity cost. Now, gold has one fundamental weakness as an asset. It pays you nothing. No dividend, no interest, no yield. It just sits there in a vault looking shiny. And for years that didn't really matter because the alternatives paid almost nothing either. But that world is gone. Right now, the US 10-year Treasury yield is sitting at around 4.4%, and once you strip out inflation, the real yield is sitting at roughly 2.2%. In other words, a government bond will now pay you a genuine inflation-beaten return just to sit there and wait. Gold offers you nothing of the sort. So when a bond pays and gold doesn't, the money flows toward the thing that does pay. It really is that simple. And here is where things get worse for all of the gold bulls. The man now driving this is the new Fed chair, Kevin Warsh, and he is about as hawkish as they get. At his first meeting on June 17th, the Fed held rates steady, but the projections told a very different story.